Welcome to our YouTube live, and the reason why I still sound a bit gravelly is because I've got a cold. So tonight's programme is brought to you by Benelin, Strepsils, and of course Lockets. And I've got some water as well. So the goal here is to talk about what the Fed said and summarise what it said, and it'll be shorter than usual because my voice won't last that long. So let's begin with a kind of summary of his points. I think clearly markets reacted very strongly to what the Fed said. So they took the Fed as saying, we're at the top of the cycle, it's rate cuts from here. So in other words, very dovish. And that was a rally in both stocks, bonds, equity. We'll look at it in a moment. Even junk bonds rallied quite a bit. Now, why would they say that? Well, if I had to summarize Powell's mood today, it was interesting. His tie was a bit askew, and he was clearly in a state of barely hidden glee, because it's pretty clear now that we're going to get a soft landing. At least that's looking very likely. Certainly this year, no recession. Next year, maybe weak growth is what the Fed's expecting. We'll see the dot plots as well in a second. But no crash in the economy. So they ticked that box. Inflation's coming down very quickly compared to other developed markets, except for Japan, of course. Very strong. Disinflation is very clear now. And they haven't had a huge pickup in unemployment, which is clearly a sign that things are good. You know, they've achieved what they wanted to do as they wanted to achieve it. And they've achieved almost the impossible, which is at least what people thought was impossible, which was to bring inflation down without a recession. So glee on Powell's face, I think. He was trying to tone it down. Several times he said it's too early to declare victory, but you can tell that he must have been partying pretty hard when he saw the latest inflation numbers. Now, he did actually say, there was one of the questions from the journalist present, which was asking him about what Waller had said, another Fed official, and whether they'd started to talk about when inflation comes down, they can reduce rates without necessarily loosening policy, because if both moves down in synchronization, then effectively the real rate hasn't changed. And he said, well, I won't answer that because I can't comment on other officials' statements, but I will say that we go through these three stages. The first stage is how fast to move, and the answer was very. They moved very fast and very aggressively, where they raised rates by 5.25 points over a very short space of time. The second question is how high to raise policy rate, how high they should reach, in other words, the terminal rate. And they think they're pretty much at it now. 5.25 they think is sufficiently restrictive. And he said that's the question we're still on, probably at the sufficiently restrictive rate now. And then naturally, people start to ask, when will it become appropriate to begin dialing back the amount of policy restraint in place? And he actually said that they had discussed that today. Previously, he'd said they weren't even thinking about it. So clearly, a change in their outlook. They now do see equally balanced risks on the upside and downside for inflation, and they are starting to think about growth again on an equal footing to inflation. So, you know, strong growth that's moderating is what they see. Labour market coming back into balance, inflation making real progress. He says there's still a ways to go, but nobody's declaring victory. There's also an interesting question about whether above trend growth is itself a problem. You know, growth is better than expected, and people were expecting a recession, but the economy is surprised on the upside. And he says, no, above trend growth isn't a problem. It just makes it more difficult to achieve our goals, only in as much as it makes it more difficult to achieve our goals. And that's because it makes a strong labour market. It produces upward pressure on inflation, and then it could take longer to get to 2% inflation. That means they could have to keep rates higher for longer, and it could even mean they have to hike rates again. So that's the gist, to summarise. Now let's have a quick look at the actual numbers themselves. And of course, we did get an update on the dot plots. This is the summary of economic projections, and we'll go through those as well. So let me just start off with the expectations. Now, if you look at what market expectations are for the policy rate, I've kind of done a time lapse, if you like, over the last almost a year now, I guess. This is in February of this year. And you can see the first rate cut was expected to be in November. Then what we started to see was the first cut move very rapidly to July of this year. Clearly that didn't happen. Then to September, then December, then March of next year, June of next year, July of next year. But then now that inflation looks like it's been licked, as of this morning, it now has moved back to May of next year. So, you know, we've had huge fluctuations in market expectations about what the Fed's going to do, when it's going to end its policy cycle. But the latest market expectation is for May next year. If you actually look at the policy statement that comes out when they update their monetary policy, this shows you which words have changed. And one of them is that suggests growth of economic activity has slowed from its strong pace rather than expanded at a strong pace. So now, instead of seeing really strong growth in 2023, we're actually dialing back those growth numbers in terms of the rate of growth. Job gains have moderated, that's the same. And the only other change is inflation has eased over the past year, but remains elevated. So they're admitting that inflation's fallen, but it still remains elevated. Previously, they just said inflation remains elevated. So they are finally admitting that inflation's showing material signs of slowing down. There's material signs of disinflation, and that clearly suggests that they're at the end of their hiking cycle. If you look at what's priced into the dot plots, the latest version of the dot plots, this is from Nick Timrouse of the Wall Street Journal, it looks like between 2 to 4 rate cuts over the course of the next year. And bond markets ripped, so this is the yield, of course. If the yield goes down, the price goes up. And this is for the 2-year part of the curve. That's very much policy driven. So markets went from 4.67 down to about 4.53 as she made this. Katie Greifeld, also of Bloomberg, said that the 2-year Treasury yield move was about 23 basis points. That's the biggest one-day drop since the banking meltdown in March. So massive move across the yield curve for US Treasuries. And when I checked on Coifin, this is the movement of US S&P 500, the NASDAQ, high yield US corporate bonds, the high yield ETF, HYG, and US government bonds. And all of them simultaneously moved up, shot upwards as Powell started talking. So clearly what was interpreted as a dovish statement. Let me just show you the latest, because that has come back a bit, I think. So this is as of right now. Let me move my face. I'll just make that a bit bigger. You can see that there was a bit of a pullback, but now it's gone back up. So NASDAQ up 1%, S&P up 1%, government bonds up 1%, and junk bonds up 1.4%. So everybody's happy about this statement. So generally a happy mood in markets. That's what we like to see. But one thing I've been monitoring is Jerome Powell's tie colour, because maybe that's telling us something about policy, which he's not saying in his main statement. So let's have a look at how it's varied over time. So this is 2 meetings ago. This is when they were still raising rates, so that was hawkish. Again, a kind of hawkish cut at the next meeting. Then we got the dovish tie, which is light grey. But today, back to hawkish. But notice how it was very poorly done up. So perhaps that means it's kind of neutral. I don't know. I'm not an expert in ties, but I never wear them. But maybe there's something to be read out of that. So now let's go on to those summary of economic projections just to see how things have changed. And I think the biggie, the really big move here, and they show you what it was in September, which is the last time the dot plots were updated, and today, the really big move is in core PCE inflation. In September, it was 0.5 percentage points higher for the end of this year. Now, of course, we're close to the end of the year and it's 3.2. But even for next year, the end of next year, we're seeing 0.2% percentage points lower expectations. So they clearly feel that if core PCE inflation is at 2.4, well, that's not far above their target. And this is their target, of course, which is core PCE inflation. And then by the end of 2025, they're pretty much there. By 2026, they are there. So that's probably why, if you look at their projected policy path, they also have revised that down. So instead of 5.4 at the end of this year, it's 5.6. Clearly, this is the last meeting of the year. That one's not very meaningful. But policy rate end of next year has moved from 5.1 to 4.6. That's a pretty big move. But why did they do that? Well, because of this. Inflation, they now think, is much more under control. If we look at those dot plots and break it down, so each of these dots is from one of the Fed participants. And the numbers you can see here, black is the current median, red is the median from September. You can see how much the end of 2024 has moved down from 5.1 to 4.6%, a very significant move. And even at the end of 2025, from 3.9 to 3.6, and then by the end of 2026, we'll be pretty close to the long run policy rate, which is 2.5. So overall, the Fed is pretty much not declaring victory, but it looks like this will be the end of the cycle, and now it's going to be discussions about when to cut. Now, of course, it's not all positive. The labour market's still pretty tight. If you look at the unfilled job vacancies per unemployed person, it's nowhere near the 2 that it was at before, but it's still at 1.4. So supply and demand of labour is coming back into balance, but still not as closely as you might think. Unemployment still remains very low, 3.1, and it did slow down a bit, the fall, but it still seems to be falling. Usually, to get this number back way down, number of unfilled job vacancies per unemployed person, you need a recession. And it's just looking very unlikely we're going to get one. So this will probably remain elevated. The only question is whether inflation can come down while this tightness of the labour market persists, which we'll just have to see. Non-farm payrolls, it was pretty high recently, so the latest print was 199,000 jobs added to the US economy. Just to keep things ticking over, to absorb the new entrants to the job market, that's the dashed yellow line, you need about 100,000 jobs added to the US economy. We're still going well above that. We have been for the last 3 months. So clearly this jobs market in America is still too strong to be consistent with 2% inflation, but they are seeing it move in the right direction. So I'd say this is probably the last area of concern for the Fed. Services as well, as we'll see. Inflation's still pretty high there. Now, this whole worry about a price wage spiral, if we do look at the jobs growth, are wages chasing prices? Well, earnings are now positive in real terms. So earnings are growing at 4% per year. Inflation is now 3.1 for the US. So 0.9% real jobs, real wage growth. Good news for US workers, bad news for US inflation. The balance sheet is still shrinking very rapidly, and there was a question about this at the end of the press conference. But it's now down by around $1 trillion, I think 1.2 trillion from its peak, which was 9 trillion, or an overall fall of around 14%. There was a bit of a hiatus for the banking crisis when the Fed lent out its balance sheet, but now the brisk rate of shrinkage has returned. Is this going to cause another problem in the repo market? Maybe, but we're still a way off not having ample reserves. It's still very much an ample reserves environment for the Fed in terms of their policy. So what kind of progress have we seen in core inflation? It's still looking pretty good now for the Fed compared to other countries such as the UK. CPI core is around 4, CPI is 3.1, both of them falling significantly. Core is the one that's most encouraging for them, of course, because that's a better predictor of future inflation. If we break it down into components and we do it month for month, month by month, so this is year by year, so November 2022 to 23. This is from October to November, so kind of more short term. You can see that several of the components are in deflation, particularly fuel and other fuels, fuel oil and other fuels, airline fares year on year, utility pipe gas service, gasoline, that's the one everyone looks at and feels, that's down 9% year on year. And gasoline, even month on month, is down 6%. So this is going to make people feel good. If you look at one single component of inflation which makes Americans feel good, it's gasoline. If that falls, happy days. So although there was a question about why people are still unhappy about the recovery, which Powell kind of dodged, but I'd say this goes a long way to making Americans happy. If we look at PCE core inflation, that's currently 3.5%, and you can see that that's been falling steadily for several months. Let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9 months of steady falls. Now, they said they want a material evidence of a sustained fall in inflation. Well, that looks pretty convincing to me. So, sure, one print can be wonky, but 9 prints, what more evidence do you need? So maybe they're being a bit too cautious now and not talking about rate cuts, but that's what we see in the numbers. Now, what's interesting, if you break it down, inflation, PCE inflation, personal consumption expenditures inflation, PCE, that's the mandate that the Fed's got. It's based on PCE inflation. Break it down into services, durable goods and non-durable goods. So durable goods would be your car, non-durable goods would be the gasoline that you put into the car. Services is going to have your hair cut, going to a restaurant, talking to a lawyer, a dentist. And it's service inflation, which is really important for the US because it's a big part of the economy, 80% of the economy. And that's still looking pretty sticky. Although Powell did say that all components, all three of these, services ex housing included, are all contributing to the fall in inflation, but this one's still looking pretty sticky compared to the other two, which have clearly gone back down a lot. So services inflation, of course, driven by wages, and wage growth is still strong, still positive in real terms by about 1 percentage point. Now, inflation anchoring, what worried me last time was in November, this 5-year forward, 5-year inflation expectations, so expectations of 5-year inflation 5 years in the future, that's a measure of what markets think is going to happen to inflation and how an indirect measure of how credible the Fed's policy is. And because this was slowly rising, it gave the feeling that the Fed was out of control. However, since then, what we've seen is a very sharp fall in 5-year inflation, such that it's back to pretty much where it was at its lowest over the past year or so. So credibility's back, and so Jerome Powell is quietly happy about that as well, as is the FOMC, I suspect. So the last question is whether financial conditions are tighter. And this is always amusing. And there was a great question by Nick Timrouse, who seems really angry at the moment. I don't know if he's had a bad day. He's very aggressive in his questioning. But he was saying markets were doing your job of easing for you, of tightening for you. You just had to hint you'd tighten and they tightened for you. Now they're doing the opposite. They're easing for you. Is that what you want, effectively? if you actually look at financial conditions index, which tells you how financial conditions really are, so tighter is red, looser is blue. Not only are they loose, they're getting looser. And that's true of all of the components: credit, risk and leverage. And this is one of the Fed's own measures, the Chicago Fed National Financial Conditions Index. So it's pretty clear that markets are easing. Markets are rallying, stocks are rallying, treasuries are rallying, junk bonds rallying. I think bank lending probably isn't easing, but that would be another sign of easing. But overall, pretty clear that this is not as tight, nowhere near as tight as we were at the tightest point, which was middle of 2022. Pretty much since then, conditions have been easing. So it's still the case that inflation's coming down, of course, partly because the shock of the pandemic, the supply chain shock, the demand surge that followed lockdown, all of that has eased, and that's been a big contributor. And now we're starting to see the slower effect of policy on activity, and it is going the right way, so it is looking good for the Fed. So overall, yeah, I think we're looking at a Fed which is quietly pleased with what's going on. They've done their job. I could just see Powell air punching as he left the stage. He went, yes, that showed them. So, yeah, but it's justified. They've done a good job. They've signalled well, despite what some people have said. I think they did a fairly good job of being very aggressive on the way up. And now they're potentially going to take too long to come down. But what they don't want is for inflation to spike again, and for them to have to hike again. A secondary spike in inflation and policy moving around a lot is not a good look. So that's probably why they're being so cautious. So I will pause to drink some Benylin and to summon my dog upstairs. If you have any questions, don't forget that if you do have a question, the people who are our supporters on YouTube will get to the front of the queue, and you can do a super chat. And I don't know how much longer my voice is going to last, but I shall summon my puppy upstairs. Here he comes. I can hear the patter of little paws. There you go, Ted. This is your disgusting treat. Just the one. I've got another one. One more. Yes. Oh, very good. Well done. You're a good boy. Brilliant. I'm going to drink some Benylin. Not for you, mate. It's for me. No, it's not for dogs. Dogs can't drink Benylin. You got a bad throat? Oh, don't sniff it. Oh, Teddy, it's not for you, mate. I've spilt it now. Not for you. It's not for you. It's for Daddy. Here we go. Right, you've given up. Given up hope? Okay. You going back down, sausage? Yep. Oh, he hasn't given up. Right, one more then. Go on. Have one more. Good boy. There's a good lad. Oh, he's so good. So good. He's had a haircut recently, so that was our contribution to the inflation numbers. It cost £70 for his haircut. Oh, he's off. And I've topped up Laura's biltong supply, so he's going to eat well tonight. He loves that biltong. So I will talk until my voice gives out, and in case you've got any questions, but please do super chat. It obviously helps us a lot if you do that, or support us on YouTube. It's very cheap to do. Oh yeah, reminder, I'll be doing this tomorrow again, hopefully with a better throat, and that's with the Bank of England. And that'll be 6 p.m. when I do that, because obviously it happens during the day and the Bank of England can't be asked. Because there's no monetary policy report, they won't be giving a press conference. So I'll just talk about what they say in terms of policy, and also go through their numbers, which they're looking at, as well as us, of course. And I'll also be talking to Damo next Tuesday at 7 p.m. So we're going to do a Christmas special with Christmas themed items. So anyway, that'll appear on our YouTube comments, our YouTube channel, as an advertisement, and we'll be talking about it on social media. If you don't follow us on Twitter, X, do. PensionCraft is our handle. Oh dear, swig the last of that. Right, over to your questions. And the first one is from Mr. Hanlon, who's one of our supporters. Nice to see you, Mr. Hanlon. He says, "Hi Ramin, I'm getting my money's worth here. The regional banking crisis was a result of rising yields. Will falling yields create outsized profits for any specific sectors, insurers or banks?" Interesting. I mean, I was just looking at the financial stability report yesterday, and this is from the Fed and for the Bank of England, and the net interest margins are looking very healthy for banks. So that's the difference between the rate at which they borrow in the wholesale funding market and the rate at which they lend further out on the curve. And those NIMs, the net interest margins, look pretty juicy. So that source of profit, lending, is still looking pretty good. Wealth management, not so good maybe for some companies who've made a big switch to trying to make money with wealth management. But certainly the NIM market, the lending market's looking pretty good. And of course, banks are cyclical. If there's strong growth in the economy, which there is in the US, then I'd expect to see good results for banks. They're going to feed further down the system from that growth. And, you know, I've got a US banking ETF, which I bought when the regional banking crisis happened in the US. It made the entire banking system fall. And I thought, well, it's looking cheap now. There'll still be a need for banks in the US. This looks like a pretty good bargain. And it took a while, but it is creeping upwards now, and I'm into profit with that. And I'm pretty confident we've still got a fair old distance to move back. So what we are seeing is kind of normalization of valuations for US banks, certainly. So is there going to be an outsized profit for the banking sector? Maybe not outsized. And I think the problem is still that commercial real estate is in a bad way. A lot of regional banks have made loans for the commercial real estate sector, and so there could be some loans that go bad there. And this is a worrying market for the US. It's $24 trillion in size, so a huge market. And if there is just a bit of a problem in that market with loans going bad, then that could have a significant impact on regional banks in the US. The big banks, stronger balance sheets, less lending to commercial real estate, less of a problem. But I think, you know, is this going to be like, you know, hugely profitable for banks? Well, you have to temper it with that in mind. There are still problems, secondary problems of higher interest rates, and commercial real estate's one of them. And as that fallout continues to work through the financial system, I think that could still cause problems for banks. But NIMs, yes, very good. So large cap US banks, I think there's still upside. And I'm sticking with that ETF in my fund portfolio. Super chat from Amir Ketobchi. Thank you very much, Amir. He says, get well soon and keep up the good work. That's very kind of you. Thanks, Amir. Khayli Mamnoon. And KK says, I think I've noticed KK before. What do you think about, so this is a super chat for almost €6. Thank you very much, KK. What do you think about investing in high quality US REITs with no debt for the next few months? Well, the US REIT market is an interesting one because it's so varied. There are so many subsectors, just as there are for the equity market in the US. And the usreit.com website is just really good. So if you want to learn about REITs in the US, just look at that website. It's just, you sometimes look at a website and think, this is very good. And that's what I was thinking when I saw REIT.com. So have a look at that and look at the different sectors, because some are more rate sensitive than others. So, if there is a beaten up sector which has been dragged down with the other sectors, but which fundamentally isn't broken, then yeah, that's something to consider. But overall, REITs, I'm not sure that I'd be getting exposure to US REITs right now, simply because I think some of the problems aren't over. So commercial real estate, if it's something like offices, we're still seeing foreclosures there pick up. And that's a really troubled sector for office space. Other sectors, not so much of a problem. Multi-housing, multi-unit housing, probably okay. Maybe that would be one of the sectors to consider. And there are other sectors that have had nothing to do with housing, things like mobile phone towers, cell towers, sorry, as you call them in the US, or data centers. So if there isn't a fall in economic growth, you'd expect data centers to be okay. A lot of those are funded with REITs. That's another sector that might be good. Hotels, maybe. If people are still going out, having fun, staying at hotels, maybe, while economic growth is still pretty good. That might be another sector in REITs to consider. Next question, super chat. Thank you very much from LC for $4.99. Thank you very much. If I'm trying to find IF/ETF World X US to no avail in the UK. Feel I'm a bit too US heavy, as world funds are so US weighted. Thanks. Yeah, I mean, the US is, a big chunk of the global markets because it's been so successful. The question you have to ask yourself is, will that success go away over the period that you'll be holding your ETF? And will you be able to time the period of underperformance for the US if it does underperform? Certainly it's true that the US does not always outperform. It feels like that now, but that's because it has over the last decade or longer. Going back to 1975, the US outperforms about 55% of the time relative to the rest of the world. So usually what happens is we have a decade of outperformance, a decade of underperformance. So if anything, we are kind of due for an underperforming period. And certainly its market cap looks bloated by historical standards. That doesn't tell you anything about timing, of course, when it'll happen. I think it probably will happen, that the US will underperform. You can never predict the reasons, but if you did want to have ex-US, you can always synthesize it. Just take a global market cap index, sorry, and break it down into regions. So go to MSCI All Country World Index, look at the country breakdown, and you can usually do that better from the ETFs than you can from the index company, MSCI. You can get a literally country by country breakdown. If you go to the iShares website, find a tracker for MSCI ACWI. I think the ticker is ACWI, ACWI, and download the constituents. And I think it has a country by country breakdown, and you can just add up the weights and then try and synthesize it with a European index tracker, a Japanese index tracker, an EM index tracker, maybe UK, and I'm just trying to think what else. Have I missed something? Canada probably, but maybe not. Canada's highly correlated with the US anyway. That's probably the best way to do it. And all you have to do is take the US weight and share it equally amongst the remaining ETFs. So you could probably do it with about 4 ETFs, maybe 5. Or you could do it by a linear combination of weights based on trying to match the returns historically. I've done that in the past, and it's pretty easy to do mathematically. So that's another way to approach it. But the simple way, just go to the ETF, ACWI, look at the country weights and try to replicate them using about 4 or 5 regional ETFs. That'll probably do the job. You know, primarily it'll be Europe, Japan, roughly equal weights of those, about, I don't know, roughly equal what those would be exactly, but Japan, Europe roughly equal, UK a bit smaller, EM a bit smaller than Europe and Japan as well. And that'll probably replicate ACWI ex-US pretty well. Next question is not there. So let's have one question from the people who are not subscribers or super chatting. I'm going to have one last sip of water. Someone says, as Buffett said, never bet against the US economy. Yeah. Brilliant. RSB also says, breaking news, free trade will shortly offer 1-month treasury bonds. Absolutely true. So what's kind of interesting about those 1-month treasury bonds, you might have thought because they're zero coupon bonds, they have no coupon, all of their return is capital gain. And for gilts, you don't pay tax on capital gain, which is interesting. You might have thought that the zero coupon bonds, because they're 100% capital gain, would have no tax. Unfortunately, the HMRC doesn't see it that way, and they tax you as if it's income, which is annoying. So that is the annoying thing about UK treasury bonds. But still, you know, it's exciting that they're offering short-term bonds, because that's the juicy part of the yield curve right now, at the short end of the curve. So it is good to see. So look, my voice is about to give out, I think. It kind of has already. Thank you all for joining us. And don't forget, tomorrow, Bank of England, 6 p.m. We've got Damo joining us. Oh no, there's another question from Mr. Hanlon, who is a member but also did a super chat. Following on from my last question, will pension providers benefit from locking in high yields over the long term? Well, I mean, if they buy high yield debt right now, they'll be buying at high prices and lower yields. So I'd say that, but I guess what you're talking about is government bonds. So it really depends on when they bought. But currently, as we're seeing yield curves move down, that's good news for pension funds. They did lock in high rates of high yields if they bought bonds. The thing is, you never know exactly when they bought them. Did they buy them after the Kwarteng budget? Did they buy it before the Kwarteng budget? Did they buy it before 2022, in which case they're a bit stuffed? So really depends on when they bought. You've got to know that to know the benefit from the yield change. So I think that's the problem. We don't know. We can see what their current mark-to-market valuation is, perhaps, but they're usually quite opaque. It's quite difficult to find these facts out from pension providers. That's the problem, Mr. Hanlon. But anyway, let me go back to saying goodnight. Yeah, FOMC done. Bank of England tomorrow, 6 p.m. Demo next Tuesday, 7 p.m. I've got my flammable shirt from Asda, which is my Star Wars / Christmas outfit. So be prepared to be dazzled by my fashion sense. Can't guarantee I'll have a party hat, but it's possible. But we will make it kind of Christmassy themed, with a look back over the year and Christmas themed sections. So Damo and I, next Tuesday, 7 p.m, Bank of England tomorrow at 6, and see you then. Take care, everyone. Bye-bye. Oh, and do like and subscribe.